So this is another quick past exam review for P4 module. So in this session, I'll focus on Blipton International Entertainment, which is a December 2008 investment appraisal question. This is one of a series of recordings where I focus on past papers, including the most recent ones, and provided that you can cover 20 or so questions at least twice, then you should be in a good position to pass this paper. So, like I said, I'm focusing on December 2008 Blipton. It's quite an odd question, but quite relevant as it focuses on appraisals with foreign aspects. So this is the question. Background. The question itself is split into three parts. You need to prepare a report for management. First of all, building a 6-year nominal dollar projection of the after-tax cash flow for a project. Importantly, distinguishing between cash flows arising from the investment phase and those arising from the return phase. And this is because in Part B, you're asked to calculate the project's dollar net present value and modified internal rate of return. This is the equation for the modified internal rate of return, where on top you've got the present values arising from the return phase, and then the present values arising from the initial investment phase. Lastly, you're being asked to provide some commentary, a summary of relative advantages and disadvantages of using net present value and modified internal rate of return as methods for investment appraisal. I started off by laying out the report, to from date, and then I effectively split my answer into two parts, where you've got the workings from 1 to 6, and then you have the discounted cash flow pro forma, consisting of two parts: the cash flows from investment phase, and then the cash flows from the return phase. So here you've got 6.2 million, and here you've got 12.7 million. Part B, I calculate the net present value, 6.5 million, modified internal rate of return, 23%, give some background commentaries, and then for Part C, make a series of brief recommendations, 6 lines in total. So in terms of the question itself, obviously go through the question and you will be able to do the workings in that order as the information presents itself. So it's December 2008, you've been hired as a consultant. The project is to do with building a 400-bedroom hotel in London. You're told that Blipton is based in Dubai and accounts for all its transaction in US dollars. So you'll get a whole bunch of inputs here, where the rate, so the exchange rate, it will be in sterling. And then the question is that the actual present values are being asked to be presented in money rates. And they have to be converted from sterling, or have to be presented in money rates and in US dollars. So you're given the US dollar of 1.4925 US dollar to a pound. You're told that the costs are £30 per occupied room. So here, this is really important. Your first input is in pounds, where you're asked to present the present values to calculate the NPV and the modified internal rate of return the NPV in US dollars. So all of a sudden you need to either convert every single line entry from pounds to dollars, which will take a lot of time, or you can calculate the cash flows, taking into consideration the the occupation, the rates, the room rates, the costs, tax savings, calculate them all in sterling, and then convert them into US dollars at the end. The fixed costs are given to you as 1.7 million per year. Occupation rates are given to you also in years, across all the years, from 2009 to 2014. We are told that UK inflation rate is 2.5%. US, the inflation rate in US is 4.8%, so it's higher, which means that if your US inflation rate is higher than your UK inflation rate, then your exchange rate of $1.4925 to a pound is going to increase, meaning that the dollar will devalue against the sterling. And we need to take that into consideration. We need to adjust the spot rate to give us the future spot rate, taking into consideration that the inflation rate in US is higher than it is in UK. So it'll act like a multiplier on that value here. Anyways, we'll cover this later. These rates are expected to be constant over the term of the project. So this is 2.5 and 4.8. That's going to be constant year on year. Blipton's real cost of capital is 4.2%, but again, that will also need to be adjusted for inflation. We're also told that the UK hotel property values within the London area are expected to rise in real terms by 8%. Now, we will only take this into consideration when we're looking at the residual value, the value at the end of the hotel in 6 years' time. But to adjust the spot rate and the cost of capital of 4.2%, we use the inflation rates that we're given here, 4.8 to 2.5%. The construction cost for this hotel is estimated to be 6.2 million, so that will form part of the initial investment phase pro forma. And it will be under construction for 12 months until the 31st of December 2009, so that's year zero. As part of the UK Olympics development plan, 50% first year capital allowance is available for tax purposes on building projects related to the games. Okay, so 6.2 million is the construction cost. We are allowed to have a depreciation on that, which we will deduct year on year, which will in turn minimize our tax. So we're told that the capital allowance, or effectively the depreciation rate that's allowed by the government, allowed for, accounting purposes, for tax purposes, is 50%. And we're told that the tax rate is 30%. So we will have 6.2 million times 50%, and then times 30% will give us the tax saving. But then we're told that the balance of the capital expenditure can be claimed in equal installments over the following 3 years. So we're depreciating 6.2 million capital expenditure over 6 years. The first part will be 50% taken in year one, but the remaining 50% we're taking over the remaining 3 years in equal installments. So think about that in terms of how you would capture that capital allowance to save on tax. There is no additional tax liability on remittance to Dubai, so we don't have to worry about that. The company has sufficient UK profits on its other activities to absorb capital allowances on this project. In making the investment decision, this type, the company operates the following procedure. All cash flows, including construction costs, are seen to arise at the end of year concerned and are to be projected in nominal money terms over the 6 years. The residual value of the investment at the end of 6 years is assumed to be open market value of the property, less charge for repairs and renewals. So we know that the construction cost is 6.2 million. We know that the rate of inflation in real terms in London specifically is 8%. So we will increase that construction cost year on year by 8%. But to get to the residual value, we'll take away the charge of full repairs, which we are told is 1.2 million in current prices payable on disposal. The net present value of the project should be based upon 100% remittance of net cash flows to Dubai and should be calculated in dollars. So we're told net present value that we need to calculate in part B has to be calculated in US dollars. Lastly, average room rates are set at the level required to recover variable costs plus 100%. So we know that the variable cost is £30 per occupied room per day. We are told that the average room rate, so the price, set at the level required to recover the variable cost plus 100%. So effectively it's going to be £60. £60 take away 30 gives us a contribution of £30. So this is what we would then be able to work out the total contribution per year, which will form part of our cash flows. So working one, future spot rates. Year 0 to 6, from 1st of January 2009 to 31st of December 2014, 6 years. And we are told what the spot rate is. As I said, is $1.4925 to a pound. We're given we need to adjust this to get this future spot rate, and we adjust it by taking into consideration the US inflation rate and UK inflation rate. Because US inflation rate is higher than UK inflation rate, it will act as a multiplier. And what it will do is it will further devalue the US dollar to the sterling. So year on year, 1.526. So you take the future spot rate brought down, you adjust it again for the rate of inflation, which is constant at 4.8% and 2.5%, and you get the new spot rate in year 2. Similarly, so that 1.56 brought down in 2011, again, you adjust it for the inflation rate. You do that year on year. As you can see, the US dollar, first of all, we start with 1.4925 US dollars to a pound, and then progressively it gets less valuable. There's more dollars to the pound. Working 2, we compute the discount rate. We need to compute the discount rate, calculate the discount rate, so we can calculate the present values in our pro forma calculation. So here, this is our pro forma year on year for the investment phase. We are told what the initial investment is. We are told what the capital allowances, or effectively tax savings. Get the total subtotal, rate of exchange, etc. Then we have the cash flows, and then we need to discount the cash flows. And this is why we need to have that discount rate, which is in working 2. We calculate it to be 9%, but we are told that the real cost of capital is 4.2%. But because there is inflation of 2.5% and 4.8%, it's quite large, difference is large between UK and US, we need to build that into our discount rate, which is here and also here, because that will allow us to go from the cash flows to present values of those cash flows. And in together, totals of the present values from both phases will give us the NPV. So going back to working 2, to calculate the discount rate, we take the cost of capital as a real rate, we build into that the inflation, it's 4.8%, and we get the cost of capital, the money rate, in money rate terms. So we get the cost of capital, 4.2%, we times it by we inflate it by 4.8%, Take away 1 to just get the percent, that as a percentage. So that's 9.2%. Contribution. So how much are we making on each room? Variable cost in pounds is £30 per room per day. Average room rate is £60 per room per day. And like I said, we are told that the operating costs for the hotel are expected to be £30 per occupied room per day. We are then told that average room rates are set to the level required to recover variable costs plus 100%. So £30 times 200%, or times 2 gives us £60. £60 take away £30 gives us £30, and that's the contribution. So much profit we're making on each room. There are 400 rooms. We're told that it's a 400-bedroom hotel. We're told that the days that it's open is 365 days a year. The proportion of bedrooms occupied on the basis of opening for 365 days a year. And then we're also given the occupancy rate year on year. So taking all that into consideration, we've got the period here, year 2009 to 2014, period 0 to 6. We have to build in the inflation rate as well. And then we get the contribution per year. So here we've got 1.8 million, here we've got 2.3 million, 4.3 million. This is in thousands. So £30 per room times 400 rooms times 365 days. We've got the occupancy rate here as well. I just simply divided everything by 1,000 here to keep the numbers quite sensible. So 30 times 400 times 365 times the occupancy rate, and then we inflate it by the inflation rate, and we get 1.8 million. To get the inflation rate, we had to keep in mind that this is compounded inflation. So 2.5% add 1 to the power of 2. So that's inflation, provided that we say keep it constant at 2.5% year on year, the compound rate is going to increase. I mean, we could have kept that as 2.5% for all the periods, but then I would have had to do the carried forward columns, where this would have had to be multiplied by 2.5% and the new occupancy rate. Because the occupancy rate changes, it's best to just start with a fixed base, where I get 30 times 400 times 365, and then inflate it using compounding. So that's your contribution, which will form part of the cash flows, the total cash flows, which will have to discount and then arrive at the present values. Capital allowances, or another word for it is tax savings, or the depreciation that we can claim on the construction costs or the capital expenditure of 6.2 million in year 1. We are told that its tax rate is 30%. UK profit tax is 30%. We are told that 50% first year capital allowance is available for tax purposes. We are also told that the balance of the capital expenditure, so 6.2 million times 50%, that balance can be claimed in equal installments over the following 3 years. So we effectively have two calculations. In year one, tax saving is 930,000. And then in year three, tax saving in year 2, 3, and 4, tax saving is 310,000. So 930 at 930 gives us a total of 1.860 of total tax savings. So that will effectively go into the pro forma here. So again, you've got year 0 to 6, got first year tax saving 930,000, and then over the next 3 years in equal installments from year 2 to year 3, 310,000 each. Total 1.86 million. We deduct that from the initial capital expenditure. So if you think about it, once we've built in the exchange rate adjustment and the discount, we are looking at a present value cost of 7.3 million. That will be allocated against the positive present values from the actual contributions from the return phase of 12 million. So by building in the capital allowances or the tax savings, we have effectively into year one, we have reduced the cost by 930,000. Here, the tax savings is effectively an addition to the profit, because we are reducing the cost of tax. We are effectively increasing the present value on the contribution. So here we have positive present values in the initial investment phase. And this is where the capital allowances go. In terms of the contribution, that will be put into the return phase. And this has been calculated from working 3, 1.8, 2.3, 4.3, 2.9, 3 million. So here we have the contributions. Now, we then need to calculate the fixed costs, because we have the variable costs and the fixed costs, so that will be deducted from the contribution to get the profit before tax effectively, and then we apply the 30% tax to get to the cash flows after tax. So the fixed cost is important to calculate, otherwise our present values are going to be overstated. We are told in the question that the charge for repairs and renewal, that the fixed cost is 1.7 million. Here we go. Fixed cost of 1.7 million per annum, expressed in current prices. So again, we need to inflate the fixed cost year on year. So again, we start with 2.5% inflation in UK, and we compound it for year 3, for 4 periods, for 5 periods, for 6 periods. 2.5 at 1 to the power of 2.5 to the power of 2. Take away 1. That's what we did for the contribution, and similarly, we inflate it for the fixed costs. So we know that in year 2, we only start paying fixed costs when we start making money out of the hotel. We're told that the hotel is under construction until the second period. So that's when we start deducting 1.7 million fixed costs year on year. then we inflate it by 2.5%. So 1.7 million times 1 at 2.5% to the power of 2, because we only start paying the fixed costs in the second period. That's why we have to account for 2 years lots of inflation. Then beyond that, year on year, we simply have the fixed cost carried forward. We apply another 2.5% worth of inflation, get 1.83 million. Then we again carry the fixed cost, adjusted fixed cost for inflation into the next year, apply the 2.5% again for 1 year's worth of inflation, as these are all constant. We're told that 2.5 remains constant year on year. And then so every year the fixed cost is inflated. And this is then allocated to the fixed cost section in the pro forma. 1.83, 1.83, 1.876, 1.876. So, like I said, the pro forma effectively needs to be split into 2 parts. Got the initial investment phase, and then the return phase. The investment phase will consist of the initial investment of 6.2 million. We are given this. So it comes out in year 1. It's the cost of building the hotel. We are told that we need to put the capital allowances. This is effectively a cost saving. It will result in positive present values. So we're told 930,000 in year 1, and then 310,000 year on year for the next 3 years in equal installments. So that's from working 1. We have the exchange rates to convert that from pounds into US dollars. The inflation rates, the exchange rates, we start with 1.4925, and then we adjust it for inflation year on year. So that's 1.526, 1.526, 1.5602, 1.5602, just a quick sense check. So we have the exchange rates, then we have the cash flows in US dollars by multiplying by the new exchange rate, and then we have the discount rates, which were calculated earlier based on 9% in working 2. So in working 2, we had 4.2% in real rate. We built in the inflation rate, and we got the cost of capital in a money rate term. That 9.2% gives us a discount rate of 0.017, 0.842, 0.772 in year 3, and 0.708 in year 4. And I got these values by looking at the present value table that's in the back of the exam paper, where for 9% in year 1 we are told it's 0.917, in year 2 is 0.842, in year 3 is 0.772, and in year 4 is 0.708. There's no point of calculating or putting down the discount rate and the inflation rates beyond year 4, as we are only told that any inputs that affect the cash flows arising from investment phase impact year 1 to year 4. There's nothing else that we're told, so there's no point of calculating the discount rates or the effects rates beyond that year. So now looking at the return phase, again, we already calculated what the contributions are year on year in working 3. So that's 2.3 million. That's coming again from the calculation at the top here. If you can remember, the calculation was based on the variable costs, the average room rate is £30 profit times 400 rooms, 365 days, and also given the occupancy rates year on year that were given, 50, 90, 60%, and the adjusted inflation, the compounded inflation. So these contributions form the cash flows in the return phase. We also have the fixed costs, which we inflated in working 6. So the contribution take away the fixed cost gives us the profit before tax, £55,528,000, £2.4 million, £1.05 million, and £1.076 million. Then we have the tax rate, 30%. We apply that, we deduct it, and then we get the cash flows after tax. But then we are also told that as well as having these cash flows, there's going to be residual value based on the market value of the hotel. The market value, we are told, is based on the residual value of the investment at the end of year 6 is assumed to be the open market value of the property less charge for repairs and renewals. We're also given the repairs and renewals here, 1.2 million. We calculate the residual value based on the cost of repair, like we told, 1.2 million. Obviously adjusted for inflation. So that's 1.2 million times 1 plus 2.5% to the power of 6. So that's 6 periods. We are told that the market value is going to be after year 6. Mind you, that 1 year was taken for construction purposes. So we have only 5 periods. And again, we inflate the market value, where we take the market value of 6.2 million cost of construction to the power of the inflation rate, 10.5%, and then to the power of 5. So that's over 5 years, compounded over 5 years. We got to 10.5 by taking into consideration that the rate of inflation in the UK is 2.5%, but then also on top of that, the rate of inflation in London is an additional 8%. So we get the residual value of around about 8.8 million. That we build into row 105. So cash flows after tax and then the residual value. Remember, we don't put the residual value before the tax because this is tax on profit, not capital gains tax. So this is not a profit, this is just the property appreciating in value. It will be subject to another tax, which for the purposes of P4, we do not consider when we create the discount cash flow pro formas and calculate NPV. So we then get the total cash flows after tax, 38, 369, 1.7 million, 735,000, 9.5 million. And we convert it from pound sterling into US dollars using the future rates that we used here for the purposes of calculating the cash flows from investment phase, which we took in turn from our workings in working 1, future spot rates. And then we again use the same discount rates as we used in the investment phase at 9% from working 2. So all in all, we take the cash flow, times it by the discount factor, and we get the discounted present values. That's the total present value from the return phase, and this is the total present value, negative value, from the investment phase. So to get the NPV in part B, we simply take the negative present values from the investment phase, add to that the positive present values from the return phase. We get NPV of 6.5 million. General commentary around that is that positive NPV would suggest that this project is viable and would generate shareholder value. The higher the NPV, the more positive it is, the more value will be brought to the shareholders. On that basis, the project should be accepted. Something along those lines. Also, one other point that you can make whenever you're asked to talk about NPVs is that both internal rate of return and modified internal rate of return provide a useful insight into the margin of error. And this is effectively what is a room for negotiation when considering the financing the cost of particular projects. So this is when we look at NPV, and then another way of calculating the worth of a project and whether a project should be calculated is most likely to use other measures like internal rate of return or modified internal rate of return. So you would say something along the lines of that one provides you with an absolute value and the other one is a relative value expressed in percentage terms. But more specifically, an internal rate of return is the extent to which the cost of capital can rise before the NPV becomes zero. So effectively, it is a margin of error, or the room that you have for negotiation when it comes to securing your cost of capital. So the lower your cost of capital and the higher your internal rate of return, the higher your NPV will be. Your cost of financing will effectively be much lower than your absolute rate of your absolute returns are. One measure gives you is a relative measure, and the other is an absolute measure, if that makes sense. Now, modified internal rate of return is calculated by taking the present value from the initial investment phase, which was minus 6.2 million in US dollars, and the present value from the return phase, which is 12 million, sum of all those present values. And you have the discount rate as well. So you effectively use this calculation, just learn it, where you've got the present value from the return phase divided by the present value of the internal rate to the power of 1 over what the period is of the project. In this case, is 6 years. And then you times it by 1 plus discount factor, which the discount rate, which is 9.2%. It's our cost of capital. You take away from that 1 to get it in percentage, as a percentage. So that formula is captured here. So like I said, 12 million divided by 6.2 to the power of 6 number of years times 1 plus 9.2%, and then you take away 1. That gives us a modified internal rate of return of 23%. So a piece of commentary that you can add as an explanation is a positive internal rate of return and modified internal rate of return means that the cost of capital is lower than the rate of return. In this case, the cost of capital has to raise to 23% from 9.2% before the NPV becomes zero. Before this becomes zero. So the higher the MIRR and IRR, the greater the return to the shareholders. So put another way, the sum of your negative cash flows from investment phase, what it costs to build a project, less the tax savings, together with the cash flows from the return phase, which is effectively your contributions and your residual value, some of those discounted, that is your NPV. That is your cash flows, your net cash flows discounted that arise from the project. Now, what will make that NPV less and less, smaller and smaller, is if this discount rate, which is expressed here and here, increases. So instead of being 0.8, it's 0.9. Instead of being 0.7, it's 0.8. Instead of being 0.7, let's say it was 0.8. Discount is much higher, which means that your present values that are further away, your cash flows that are in year like 3 or 4, 5 or 6, if this discount factor there is higher, then these present values are going to be much, much smaller. And if they're much, much smaller, then your NPV is going to be much, much smaller. Just think about it. The higher the discount rates, the smaller the NPV. Because the cash flows in year 3, 4, 6, the later ones, they're going to become discounted a lot higher. So these values here are going to be much, much smaller. Instead of saying, and this is directly related to your cost of capital, because your cost of capital is your discount rate. So instead of having a cost of capital of 9%, let's say it was 15%, then your NPV would be much smaller. So this would have to be, so the discount rate would have to be much, discount rate would have to be much higher. So from 9%, it will go to 10% to 15%, which means that your discount factor will become a lot smaller. So instead of being here at 0.6, it becomes 0.3. Let's say 0.3 again here. .3. So as you can see, the NPV here goes from $6 million to a 1.3.268. It's because you're increasing the discount rate and making the discount factor a lot smaller. You're reducing the size of your present values by increasing your discount rate and reducing your discount factor. Your present values become much, much smaller, which in turn makes your NPV a lot smaller. So going back to my point about internal rate of return, if your cost of capital is your internal rate of return effectively tells you that how much the cost of capital can increase before the NPV becomes zero. So how far does this discount rate, which is your cost of capital, have to increase before your NPV becomes zero? How far do these discount factors have to become smaller? How far does this have to increase before your NPV becomes zero? And here, the discount rate will need to increase to 23%. So something's changed there. To 23% before your NPV becomes zero. Finally, the recommendation is the project is expected to deliver an increase of 6.7 million, our current cost of capital, which is 9%. You say something along the lines of, I've used NPV and IRR to determine the viability of the project and whether they should be accepted. Then you start talking about each of the methods. So NPV is the sum of all future cash flows discounted to present values using company's cost of capital, which here is 9%. NPV is based on a number of high-level assumptions, but it does provide an absolute level of measure of shareholder value. Modified internal rates provides the headroom for the company's cost of capital. So like I said, in this case, modified internal rate of return of 23% is 14% higher than the company's cost of capital. of 9%, and as such suggests that the project should be accepted. So the cost of capital will have to raise from 9% to 23%, almost an increase of 14% before the project becomes not viable, before it stops generating any return. Modified internal rate of return assumes that any surplus cash flows are reinvested at the firm's current cost of capital, whereas internal rate of return assumes that the investment occurs at internal rate, which may not be the case in practice. So what that effectively says is that these cash flows that we generate year on year, they get reinvested back into the project at the internal rate of return. Thus, in this case would be 23%, whereas what modified internal rate of return would say that they would be reinvested back into the project at 9%, which is a little bit more realistic. That's all that it means. So yeah, that's Blipton in summary. Bit of an interesting question just because you have to have these effects rates that have to be adjusted for the rate of inflation between US and UK. And we also have to create these separate pro formas for the investment phase and the return phase, because one of the measures of whether the project should be considered is this modified rate of return. So it's an interesting question how they managed to put everything in there. I think the next one I'll probably cover is teaser or Fubuki, which is an adjusted present value question, and the other one is a risk-adjusted WACC question. Cool. Speak soon.